Welcome to the StockOptionAssassin.com's profitable swing trading lesson. My name is Eric, and in this video, I'm going to show you a recent low-risk trade from our market timing service that gave us an 18% gain in just a few weeks. And the ETF we traded for this was the IBB, also known as the NASDAQ Biotechnology ETF. But first, let's go ahead and take a look at the chart, and let's take a look at the indicators I'm using here. And so what I've got on the chart here, with the price, is a modified Keltner channel that measures extreme average true range. I've also got below the chart a DMI oscillator, which is the directional movement index oscillator, and also the DMI stochastic extreme, which is also based off the directional movement index. And these indicators are help identify changes in momentum or reversals. But before we talk about the indicators, I want to point out a couple key levels in the stock first. And so first, you can see here, I've zoomed out a little bit. You can see back earlier in the year in February, the biotech ETF, IBB, came into some resistance up here at about the 275 level. So that was the first level that was kind of a key level, and that really sparked a major, not the level sparked the reversal, but that's where the reversal started. That was sort of the intermediate term top. And as I zoom in a little bit, the next level we were kind of keying in on here was this, which was in June, early June, and this is kind of where the ETF sort of found resistance again. This was at about the 265 level, and it kind of pulled back, and it managed to kind of come back up and was starting to retest that. So here's where our trade happened. So now that we've kind of identified a couple of key levels, so let's zoom in a little bit more. So with our modified Keltner channel, you can see that we were trading outside the band. So what that means is that the ETF is trading at an extreme level according to the range that it's been in. And so when we look at stocks and things that are trading outside here, we look for potential momentum shifts. Now, on this particular day, this was the day we entered our short trade, and we'll talk about the trade here in a second. But the trade we entered was on August 19th, and the kind of entry signal here was our oscillator had ticked down. You can see on this level, if you look at this, the numbers are right here. On this day, on the 18th, the day before, it was at 2296.07, and the next day it ticked down ever so slightly to 22.65, right? And then it also had a corresponding move down with the DMI stochastic down here, where you can see here it was at 100. It was at 100 for several days. So whenever your DMI stochastic extreme is at 100, there's some bullish momentum going on. And we were kind of looking to take advantage of the reversal or a pause here. And that ticked down to basically 98. So it wasn't a huge tick down. It wasn't like we had a huge reversal candle or anything. So it wasn't, what we wanted to do is get short, but we didn't want to buy puts or short the ETF. So instead, we decided to put on a bear call spread or call credit spread. And here's the reason why. So first, this was kind of a first hit of this 265 level. This was sort of the first retest. So we thought one of two things were going to happen. Either the stock is going to pull back from here and maybe retest at least the lower band, or maybe even these lows, or it could actually rally a little bit and come up to the 275 level, which at that point, if it's still in kind of an overbought manner, we thought that the ETF would pause up there. So instead of buying puts, we ended up selling the 275, 280 bear call spread, where we sold the 275 call and we bought the 280 for protection. And we knew that there's a potential we could take a little heat on this, which we actually did. But ultimately, that 275 level held. It kind of pulled back and retested 265. At this point, 265 is acting as support. Remember, previous resistance acts as support. And we kind of chopped around here. And I'll zoom in a little bit more. This was the day that we took the spread off. Let me bring in my arrow here. This was the day we took it off, because we had there was a range that was sort of being established here between about 265 and 275. So when we retested that lower band, and we were kind of getting oversold both on the oscillator and the DMI stochastic extreme, we took the trade off. So let's talk about what how much the spread was worth and all that. So first, remember, We sold the 275 and we bought the 280. So this is a $5 strike spread. So the spread was $5. We took in a credit of $1.10 when we entered the trade right here. So that leaves our risk, because the risk is the difference between the strikes, in this case $5, and that has a horrible 3. But there we go. So the $5, we took a $1.10 credit, and then our risk at that point is $3.90. So during this time, the trade, like I said, we took a little bit of heat on it and it came back down. Well, if you'll notice that when we got out of the trade, it was trading basically about the same level we entered the trade, but it was 2 or 3 weeks later, and we were able to buy the spread back for 40 cents. So again, we sold something for $1.10, we bought it back for 40 cents, and our net profit on that trade was basically 70 cents for that trade. So we made 70 cents on our $3.90 risk for that trade. And so the reason why, and this is a question I get a lot, is understanding theta when it comes to options. When you sell out of the money options, theta is in your favor, and every day time passes, those options lose in value. And when they came back, when the stock pulled back to this level, those options were slowly becoming worthless, and we exited, bought the spread back before expiration, and that was our trade. So I hope you enjoyed that. If you have any questions, let us know. If you'd like to learn more about the trading strategies, click the Learn More button, and we'll see you in the next video.